Awesome! I'm so excited to talk to you about our second stock here, which is Activision. They are so fun. For those of you who don't know, I used to be super hardcore in gaming. Like, I spent all my time playing video games. It was crazy. And so a lot of my initial investments, a lot of the things I first invested in were companies that I sort of knew about, companies that I understood. And so because of that, I had sort of this sphere, and this was a big part of my portfolio. And this sphere was sort of made up of like tech. The sphere was made up of stuff like around the gaming space, which again is mostly tech. And so that's kind of what influenced, I think, a lot of my first investments, Activision included, is that's sort of what I was comfortable with and I believed was going to be like a super hot market and was going to be a great thing to invest in. And I think it's interesting because, you know, there are literally like thousands and thousands and thousands and thousands of these stocks all over the place. I mean, there is just so many public companies. It would take like forever and ever to go through every single potential investment ever. And so a great heuristic to follow when you're starting out is to just figure out like which of these investments do you already kind of understand the market of, and then invest in them. I have a lot of friends, they work kind of in the medical field, they work in the health field, and so they started investing in this one sector of the economy. They started investing in healthcare, and they absolutely crush it when healthcare booms, and they do really well because a lot of their stocks, a lot of their portfolio is weighted in that sector, right? And so when you have a lot of your weighting in one specific place, that's going to obviously create a pretty big, like we were talking about earlier, correlation where, you know, if this sector goes up, your portfolio goes up, your portfolio will be highly correlated to one specific sector. And that's okay in some situations, and it's not as great in other situations. And I think with Activision here, we're going to see one of the first examples of how this can turn out really well, and how it can also kind of backfire on you if you don't have the right setups. And a lot of it comes down to market timing. A lot of it comes down to like the actual overarching market. And if the market's expanding and it grows and it grows and it grows and it grows and it grows, then you're going to do really well. But if the market's contracting and you know, that's gonna not be a great time. It's not fun to hold through. And so what's cool is like when you combine sort of the initial stocks you pick, and once you actually have this pool of potential and your real potential and real investments, what you can do is pretty simple. It's pretty amazing though. Is you take these investments and you actually apply technical analysis, and you can actually apply what we've been learning with technical analysis, and you can say, hey, you know, these guys have never been below this line for a really long time, and the moment they drop below that is probably when you want to get out. The moment they drop below this 50 moving average, they hit the 100 moving average, is probably when you want to get out. And so those are some really strong tactics that you can use, and I never really knew about, and so I never really got to use until I learned them, and I was like, holy crap, if they tank down with this moving average right here, and they have very rarely ever been at this 100 simple moving average, and they do it really quickly, and they're super far above 200, it might make sense to take a little bit of profit off the table. So with that said, let's actually walk into the investment from a fundamental side, because this was sort of a longer term investment. And what's interesting is fundamentally they kind of like, you know, any normal company. Now obviously these are kind of delayed stats, but you have a pretty reasonable PE, about 30. I mean, they make money, they have a solid market cap, and you know, if you look at stuff like stats and you're trying to understand like the foundations of the company, you know, they like have a book value about $16, which is pretty reasonable. You know, at least they actually have a book value. Their float, you know, a couple $100 million, so it's pretty reasonable. What I liked about them when I first got into them was when you look at their financials, like they're making pretty consistent revenue. This was obviously afterwards, you know, I invested earlier on. And they were kind of increasing the revenue more and more. Like I talked about earlier, you know, if a company just makes more money, then like theoretically, like they should do pretty well, and it should be kind of solid. But you still need to be careful. You need to exercise caution. Something that's really important is you need to realize when you've had a really big period of growth. After you've had a really big period of growth, you need to realize kind of when it might be time to take stuff off the table. When it might be time to maybe sell a little bit of your position, especially if maybe getting out here maybe not necessarily means that you're missing out on totally huge gains, but it also protects you from the downside, right? Sometimes you sell half a position, sometimes you sell a quarter of a position. A good rule of thumb is if your position doubles, you know, sometimes you can sell half, or stick in it if you know that it's a really solid company. For me, I didn't really know exactly what was happening with Activision, and there was some pretty harsh news. Some of you guys may know, like Fortnite came out, and Fortnite was free, and then their stock tanked like for a very long time because it really crushed their public image, crushed their appeal. And with the moment you have some of that detrimental news, the moment you, and this is tough because we talked about earlier, like news is not really a definitive reason to make any investment. And more often than not, like, the news is going to be on the news. It's going to be like everyone's going to fail, and then it crushes it, right? And so what's interesting though is this news, like this idea of, if you have news and you combine that with technical analysis, and technical analysis validates that. Means what you can use is you can look at the news not as some sort of outside perspective, but instead look at it as a catalyst, right? So you want to look at it as something that could cause stock and the price to actually shift really, really quickly, only after it already has a setup, and only when you're actually validating the setup. And so with Activision, basically what happened is they had a really solid history. I mean, they have been absolutely crushing it. You can zoom out even more and you can look at them over time. I mean, they just have been doing really, really, really well. And obviously they have a little bit of market volatility, but basically, they've been doing really, really well. And so what I decided is like I bought it like kind of right at the peak in the short term. And then I held it and it kept going up and went down and went up and went down and went up. And what it did was kind of interesting because you see it at the top here, it keeps bouncing between sort of a support line right here, a resistance line up there that I can't really reach. And once you see that, what's important is to understand that there's a lot of sort of balance in the price. That balance in the price very often is going to come from a indiscrepancy of price. It's going to come from people not really knowing how to value the company. If people don't know how to value the company, what happens is something like a bad news event, something like a catalyst, can have a geometric effect. It can have an effect that would be much greater than it would normally have, or something would normally have, if it was just a traditional movement. If it was just the stock taking a temporary pullback, and maybe you think it's going to bounce off of that, like that can only happen if there's not what's called like an emotional response from the majority of the investors. If there's not a pullback from their confidence, there's not a destruction of their belief in the investment. If there isn't, you really need to be careful because people get emotional, right? And this brings us into this next concept that is so critical, because catalysts, they all lead to kind of one thing that's really the most important thing you can focus on, and that leads to emotion. And what happens is really interesting. When people get emotional, all of a sudden they start making these investment decisions, not based off of the value of the company, not based off of PEs, not based off of numbers or facts or stats or financials, but instead what happens is you have financial markets and they move based off of consensus, and consensus will fall around emotion. And so as you get more and more people afraid of a downturn, more and more people are afraid of downturn, more and more people are afraid of a market competitor, more and more people are afraid of something, fear, greed, all these negative activities actually leads to what? It leads to people freaking out. And so that's why it's really important to always have a stop loss, right? So this investment, I got in here about 66, it's like right about here. And like the moment that this hit here, or here, I actually stopped out of that position. At least I didn't have control. With this portfolio, I sold a lot of these stocks right here in 29, like on my birthday when I turned 18, I got all my accounts back from my parents. So I think I sold this one probably for a loss, to be honest, like 55, but it's kind of rebounded since then. But what happens is like you have to have a stop loss here, especially when you're initially entering your order. It's some reasonable price level, like some reasonable support level, because the moment it does is like it's going to keep going up. And this kind of gets into our next part, which is like, do you want to have like short-term or long-term profits? And I think the question comes down to sort of how skilled you are at active money management, because like if you're really phenomenal at short-term investing, if you're really great at just making these trades, right? You buy here and you sell here and you just base it off of this MACD crossover, this stochastic, super low buy, crossover buy, super high sell, crossover sell. You can make what? You hold from 50 to 64. Like, that's great. And if you're great at that, then you get a big check mark here. But here's the deal, okay? Like there aren't a lot of people that are just gonna spend their entire day looking at Activision stock. So what you can do if you want to sort of have this kind of trading style where you're making it on the upside, you're having much less risk because you get in here, you set stop loss like super tight, and you're careful with it. You know what you're doing. Like if you want to do that, it's really important to follow a simple plan of action. But the plan of action is very powerful. And what you want to do is you want to have small effort short-term investments, because what happens if you try to spend like 10 hours a day every single day over and over and over again, looking at the same stocks over and over, like you're gonna get just tired and bored. And for most people, that's just not a sustainable thing to do. Even if you're managing billions of dollars, like looking at Activision stock, this is a weekly chart. Like this is 2 or 3 months. It's not gonna happen overnight. And so it's really critical that you sort of batch some of these shorter term trades together. And what I like to do is, if you trade 9 to noon, basically you have kind of like the first hour, hour and a half, 2 hours of trading, just active, day trades, right? And then after that, you can spend sort of the last little chunk of your day, how much time you want to spend, looking through a variety, and this is the critical part, a variety of stocks, right? And so at the end, what's happening is you have maybe a list, and we'll call this list, your variety list. You got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 or so stocks that are kind of like Activision, maybe a little bit different. And these are stocks that you're kind of intending more swing trades. So for me, when I got into this investment, this was sort of more of a long-term investment. I wasn't thinking about how I was going to buy this stock and sell this stock in a month or two. I was thinking like, this is probably a solid company, and it makes sense to sort of invest in, because of sort of the background I had on the market, the information I knew about it, and they had solid financials. And so really, like, that's just all you have to look for, and it's just a question of like, does it work out or does it not work out? And it's sort of a market play at that point. You're betting either the market going up or the market going down. What's interesting is you start to get more and more and more and more of these investments in your portfolio. What happens is, this is your portfolio. It's got however many stocks. It's got 40 stocks. This one has like, you got 40 stocks. Okay. And then you have like the S&P, you have the overarching market. And when you have the overarching market, it either closes up for the day or it closes down for the day. It's one or the other. And what's cool is like with most like long-term portfolios, when you're using just like normal allocation, I'm talking only about investments in equities, only about investments in stocks and bonds, and what you're gonna see is with that specific segment of your portfolio, like that specific asset, just the stock, your portfolio is usually gonna mimic what the market does. Like if the market goes up a bunch, you're probably going to make a bunch of money that day. If the market goes down a bunch, you're probably going to lose a bunch of money that day. And so really what happens is the goal kind of turns into, with these long-term investments, where you aren't 100% confident. And this is, again, strictly with long-term investments, where you're not 100% sure on what's going to happen next. You're not 100% confident on what's going to happen next. And it's frankly difficult to predict the best long-term investments when all you're doing and all the mental power you're putting in and all the effort you're putting in is just, is this a good company or is this maybe not a good company? But that's all you're doing. What happens is suddenly you shift, right? So there's a shift, and all you really want to do from this point forward is you want to have your portfolio go up more than indices when they go up, when your portfolio goes up, and you want to have your portfolio go down less than indices when indices go down. And with this simple concept, with that simple framework, what I just told you is literally what's allowed my long-term portfolio is almost triple indices performance with like very, very minimal effort. Like with this portfolio I created, it literally took freaking maybe 10 hours of work, and I used it for years and years and years and years and years and never touched it, right? And the reason why is because like once you have the investments, and if the investments are working, you just let the investments work, and then you kind of just reap the rewards from it, which is pretty much the strat, that's the goal. And so with stuff like this, you have to sort of make a distinction going into it. Like, do you want to make this like a long-term thing that you just don't worry about, don't touch, you kind of treat it like any other investment, you just want to hold it and see what happens and not care, put no energy in? Or do you want to make it something where you're sort of like taking it and putting it into a small effort, like active, short-term management bucket? And here's kind of the key is when you put things in this short-term bucket, it's important to make sure that you still have focus, right? So you really can't have like 100 stocks that you're looking through for this small part of your time every single day. But if you're contributing maybe an hour a day, maybe an hour a week or something to these investments, it's important that like put in just a little bit of effort per investment, because like literally looking at the chart for, I don't know, 3 minutes is, and I mean I've been doing this for a while, so I mean it might be longer for you, but let's say that it takes you 10 minutes to pull up this chart. Let's say it takes you 10 minutes to look at, for instance, this is a nice, that's a W setup. If you don't know, W's are pretty basic. They look like this, they look like a W. You can kind of see it kind of right here, it's a nice W. And basically you want to see a breakout here, and you want to have a support here, and you take it this height, you hack the top, and that's your target, right? And so for here, you just kind of take this, add it here, and that's your target right there, 155, make, I don't know, 10% on that trade. Now, like, it depends a lot on like the effort you want to put in, because you can trade, you can leverage that with options. You can have more upside with options. You're making 10%, 5% make, I would say, give or take 60% on that stock. That's a really phenomenal thing to do, like when you have the expertise. And so here's the strat. Like, say it takes you 10 minutes to go through this chart. First time you go through, but every time after that, all you're doing is checking the price. All you're doing is checking to see, has this stock gotten to the breakout point yet? Has this stock gotten here? And by the way, this setup is very, very much strengthened if the W movement is inside of the Bollinger Bands. It's usually a Bollinger Band setup, and it works really, really well over and over and over and over and over again. And so, like, and the W in the middle part right here, by the way, is usually just a little bit lower than the rest of it. Sometimes it's about half the height. This time it was pretty high up. So, anyway. Say it takes you like a couple of minutes to look at this chart the first time you see it, and you're like, okay, look, we've got a crossover on this MACD, that looks really, really good. Crossover on this stochastic, that looks really, really good. I want to wait for this W setup to complete, and then I want to buy it, and then sell it when it gets up here. Like, that might take just a little bit of effort every single day, but like all you have to do is wait until you have the day when it actually gets to that point, and then once you get there, you just buy the stock or buy the option or whatever. And then you're golden. And so here's the thing though. So say you spend like a couple of minutes on that, maybe 5 minutes on that. What that means is if you're gonna block out an hour of time a week, and this is a weekly chart, so you could get away with doing this on a week by week basis. Say you're gonna block out an hour of time to look at your stocks, that means that right here, you're gonna have what, 60 minutes divided by what, I don't know, 5 minutes of stock. I mean, it literally takes me like probably 15 seconds to look at this chart and understand it, but let's say 5 minutes, okay? We're gonna be super conservative, super conservative. Okay, what's that? All right, that's 12 stocks, right? So you can look at 12 stocks every single little hour chunk of time that you have. And we're gonna think about, okay, well, what should I do? Well, you have to pick, like, what are those 12 stocks gonna be? And the way you do that is by looking at upside. So with Activision, this is a stock that might move 5%. This is a stock that might move 10%, maybe. I mean, this movement right here is huge. If you look at the chart, it looks huge. And I don't know, that's like maybe a 12% move, And I see this all the time. People that will literally spend like hours and hours and hours of their time charting out stocks that move like 8% off of a setup. And that works out really well if you leverage it with the options, which is great, and it can work. I mean, it's phenomenal. But when you're starting out, you probably don't want to start out leverage with options, just because it's kind of, you need to like know what you're doing before you get into options. So when you're starting out, the question is, how much can you actually fit into this list of things that you're focusing on short term, and how much of the rest you need to be careful, because people get emotional, right? And this brings us into zero effort whatsoever towards managing it. You check it maybe like once a month for like 4 seconds to figure out if you lost a bunch of money or made a bunch of money. And that question kind of comes down to, like, what are going to be the stocks that you trade that are predictable, right? Because you want to have predictable stocks, but on top of being predictable and being like well traded stocks, high liquidity, stuff like that, you also want stocks that are what? You want stocks that are high upside. And this high upside usually means what? It means higher volatility, right? And so what's cool is you can use the exact same setup, the exact same pattern, the exact same strategies on different investments, on different portfolio positions. And all you have to do is what? You just have to make sure that you're picking the right stock. I remember so many times I would be trading different stocks, and what's interesting is you can see the exact same setup on one stock, right, as you see on another stock. But what happens is this, let's say this first stock, right, versus the second stock, you can have the exact same setup. But let's say we have like an ABCD setup. I see this all the time with ABCD setups, and it's absolutely crazy. Okay, you'll have this ABCD setup, and you'll have kind of this ABCD setup. Okay, and then you buy it here and it explodes. Right, you buy it here and it explodes. And let's say this is like a $40 stock, and this is $8. Okay, and we'll call this 5-day time period. 5 days. I recently had a trade, oh gosh, what was the ticker? I think it was GMPS, exact same setup. It was a W setup, it was not this setup, but I think that trade net like 118% gains. It was on straight stock too, went from like $2 to $5. Oh, crazy, so good. This might go to like what, I don't know, $44, and this might go to like $12, okay? Now, you make $4 on both stocks, but $4 here is 10%. $4 here is what, like 50%, right? And so you have 5 times greater upside on this investment with, granted, you know, you're probably risking like, I don't know, 50 cents here. And you're probably risking about $1 here, which is, I don't know, $1, maybe 50 cents here too. I would say probably 50 cents here. It has not the cent sign. So you're risking, I would say, probably, you know, 16%, 10%, probably about, well, 10%, yeah, probably less than 10%, so that's like, you know, 6%. Don't hate my math. Probably about, you're risking about 6% here, so you turn 6% into 50% or whatever. And here you might be risking 1% would be, you know, 4, so give or take about like 0.2% or something like that, like something smaller for sure. When you cut aggressively, you can say like, you know, 1% or something. If you risk a lot less here, and in return you get a lot less. Where here, you know, you're risking a little bit more, but like the ABC setup is a very, 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 very solid setup. So like once you know that the setups work and that the foundation is there, all of a sudden you can make like so much more by just following the right tickers and trading the right stocks. And you can trade the exact same setup on different stocks. What happens is really interesting. What happens is you get like 10 times more upside because you focus on the ones that are actually going to give you more volatility. And this is something that comes after you kind of master your technical analysis, but it's not that tough to identify an ABCD setup. And I'm not saying like don't take trades on, you know, maybe slower moving stocks like this, but what you need to do is you can identify like, look, if I can only look at 12 stocks consistently without like freaking myself out over and over again, then maybe, you know, it would make sense to put most of my effort into managing the stocks that are going to go up 50%. Then the stocks are going to move like, you know, 10%. And like I said, you can buy options with a strike price expiration of like 44 right here. And then those might go up by a factor of 10. And if those do go up by a factor of 10, then like by all means, leverage the hell out of it. If you're trading options, you can definitely make it worthwhile to trade the smaller moving stocks because the options are usually pretty cheap. I mean, this could easily be a 10x return with options. So just make sure like if you're getting into that span, you want to have, like you want to be able to do this before you do this with options. Because when you do this with options, what happens is you're risking basically 100%. And usually in reality it's more like 70%, but you're risking a pretty solid chunk. It's a lot more risk. Like people say this is risky, but then you get into this, and this has way more upside. This literally can turn what could be a worthless trade to a lot of people into a ridiculously lucrative trade to you. So you want to make sure that you're able to do this first, be able to get graded stocks first, and then kind of transition over into options. And that's sort of the path that has worked really well for me. Because like if I bought calls on this investment and then it went down a whole bunch, like those would be worthless, you know, and I lose my entire investment versus, you know, a couple of percentage points, right? And so basically what happened here is I made a bunch of money at the beginning and then I didn't really like do anything with it. I don't know, maybe I made like 10% or so, 15, 20%, and then I didn't do anything with it, which was silly. And well, it wasn't like if the stocks didn't keep going up forever and ever and ever, like, you know, it makes sense. And if you believe in the long term this company is going to be worth hundreds of dollars or, you know, thousands or whatever, then like, you know, it's worth, you know, holding on to it. But if you don't have like that conviction or you don't know like what's going to happen, then like very often it makes sense to, you know, take gains, especially when you start to see stuff like this. So I think what happened with this investment is I wasn't like paying enough attention to it, and so as it hit this, actually no, I was totally paying attention to this. I remember it too because there's all that stuff about Fortnite. I just didn't do anything, and so I think that's the second really big thing is when you make an investment. A lot of people, they make a lot of money from it at the beginning, and when they make a lot of money from it, they say, "Oh my gosh, this is awesome, this is great," and then they start to take, they don't touch it, okay? They don't touch it. But then there's other investments where they make a lot of money from it, but then they start losing a little bit of money. And what's interesting is you get to a certain point where both of the people are at the same spot. And the person who makes a lot of money is like, all right, you know what? We made a lot of money. I'm going to start taking some profits off the table. I'm going to start taking some money off the table. And so that's what they start doing. And they start taking money off the table. They start taking some of their profits. They start limiting their upside. So that's like basically if somebody bought here, the stock went way up here, they're like, oh my gosh, I made so much money. I better start selling, and they missed out on all this upside. And that's like that's a pretty common thing to do. People want to take their winners really quickly. But then think about it like this. There's this other group of people that get in the investment. What happens is really interesting. They buy, like say right here, say right here, say right here, and it goes down a whole bunch. They buy and it goes down a whole bunch. And instead of like saying, let me stop out of this trade, let me get out of this trade because I want to limit my downside, just like they technically limit their upside, They hold, and they hold for it to get out, and they hold for the stock to keep going up later and later and later in the future. So it keeps going up more and more and more and more because they say, oh, it's got to come back, it's got to come back, it's got to come back, it's got to come back. To kind of, and so there's two things I want to do. The first thing, I'll do this over here real quick. The first thing I want to do is I want to finish up with Activision, and then I want to give you an example that will kind of show you that mentality and clarify that for you and show you why it's a really bad fallacy to fall under. So if it's okay with you, what I'm going to do is I'm going to finish up here, then we're going to move on to finish that thought. Okay, is that cool? All right, sweet. So the last thing to kind of focus on here is obviously you want to have like a condensed list. Like I know so many clients, and they're like, you know, going through my education, and like, oh my gosh, the coolest thing ever, I want to look at a bajillion stocks. And the thing is, like, it's really difficult to manage like 100 stocks at the same time. And so it's much better to have like 5 or 6 stocks that you're doing actively. And I mean this actively, because with long-term portfolios, like my long-term portfolios have like 40 stocks. And the reason why is because I don't freaking know which one of them are going to go up. And if you're genius, what I do is my long-term portfolio is not a significant chunk of my manageable assets. The reason why is because I make like 10 to 20 to 30 times more in a month in my swing trades and way more in my day trades. And so it doesn't make sense for me to put a lot of money in my long-term portfolio. But for a lot of people, they don't actually manage their investments and they think they should just put everything in their long-term portfolio, and that's what they do. And so it's important to understand that because it should always be sort of a chunk. It should always be a part of what you do, because if you have long-term investments, at the end of the day, that's going to be something that can literally last with you for decades and decades and decades. Fundamentally allow you to have the impact, have the growth, and actually have like the savings and retirements. They're going to give you that financial freedom over the long term, and that's really critical, and that's something that nobody can take away from you. And this should be very difficult to take away from you because you're investing in quality stuff, right? You're investing in really good stuff. And so what I want you to understand here is that you can have like as much stuff here as you want if you like totally believe in this stuff. And please have enough so that your entire portfolio doesn't depend on 2 or 3 stocks. Because like if you do that and then one stock goes down, it's just not good. And especially if they're highly correlated. Like I see a lot of people, they start out investing and they have like Apple, Google, Netflix, and that's like the whole portfolio. And I'm like, dude, that is phenomenal. You're gonna crush it in a bull market. But the moment that the market starts to go backwards, those are basically the same type. You're owning, those are all basically the same stocks, correlation-wise. And so, you obviously have to balance your portfolio just a little bit so you don't lose everything at once. You just want to apply a little bit of common sense to sort of the investing that you do. Okay, does that make sense? Is that cool? Is that fair? All right, sweet. So. Last big thing takeaway here is that you want to sort of condense down to your potential investments into a smaller list and a more manageable list, because once you have a manageable list that you can actually understand and follow through with over and over again, it becomes way easier to actually get those end results and more significantly make those trades. Because in reality, there is a total and complete abundance of potential investments that exist. I mean, there are a ridiculously great number of stocks all over the place. Like we talked about sort of in the introductory to this class, you can have any trading strategy you want, and you just have to apply that trading strategy. And in some days, one strategy might make more money than another, but in the long term, if you just stick with your thing, you just stick with what you're doing, and you just trade the stocks that you have in front of you, you're going to profit on them as long as you make the right choices, right? And so it just comes down to sticking with a couple, because if you have 100 different stocks, trying to dig 100 different holes, there's no chance that you can dig each of those 100 holes as deep as you can dig 2 or 3 or 4 or 5 or 10 or 20. And so you want to go really deep in just a couple of your investments. Pay really close attention to a couple of your investments, because in reality, a minority of your investments lead to a majority of your results. And so that's the big shift, and that's what happens when you make your investments. You understand that you've got to go from baseline nothing to actually achieving that result, and actually moving towards having that little list of things that you're constantly managing and you're checking in on over and over again. Because once you have that really condensed watch list of things that you know are right about to move, all you have to do is sort of stick with them. There are so many investments I have, just like this one, where there was a big movement and I just didn't give it the time that it deserved to actually analyze the investment. And the reason why is I used to be super overloaded. I have 500 stocks up at the same time, trying to look at everything. And that just doesn't work, because you will get distracted, you get off focus, you won't be able to stay in sync with what actually matters. So the big shift kind of comes when instead of trying to do everything, you just pick a couple of things and you do those really, really, really well. It's kind of like specialization. You really just want to hone in on a really powerful subset of investments that you can make, which is super cool. Now, with that said, I'm really excited because a lot of people, they see this and they say, oh crap, it went down, I better wait for it to go up. And Activision's a solid company. Like by all means, they might go back up, I don't know. But, and they had a Mackie crossover, which is pretty sweet. I want to show you this example with a stock called Popships. Now Popships used to be one of the biggest shipping producers in the world. I mean, literally, these guys, they owned all the ships, they were absolutely crushing it, they were amazing, and they just used to be huge. Their stock price, I don't know if you can see here, it was we'll call it about $160 billion. Now, for those of you who don't understand that, let me draw this out for you because I think it's pretty important. Their stock price was, I'm gonna draw this in red, okay? Their stock price was $160 billion. Put 2 little cents on there. $160 billion. To buy one share of this company, you needed $160 billion. $160 billion. $160 billion. Okay? I don't know if you guys can see up in the top right over there where it says 64 cents. Yeah, that's how much their stock costed. 64 cents. Now, these guys would have out 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. About 10 reverse splits. And what that means is about I think each of these reverse splits are about 10 to 1 reverse split just based off of trading the stock forever. And reverse splits, really, really simple. Basically, they have 100 shares, it turns into 1,000 shares, and they're worth 1/10 as much. And when stocks do that, it's usually because they're really, really bad stocks. Case in point. And so, this stock went from $160 billion to 64 cents. Now, a lot of people might have bought in when it was only at $140 billion, maybe it was only at $150 billion, maybe it was only at $50 billion, maybe it was only at $20 billion, maybe it was only at $1 million, maybe it was only at $40,000, maybe it was only at $20,000, maybe it was only at $10,000, maybe it was only at $6,000, maybe it was at $5,000. Maybe it was at the bargain price of $2,000. Maybe it was only $1,000. Maybe it was only $600 for this bargain of a stock. Maybe it was only $40. Now let me ask you a question. You buy a stock for $40 and it's worth 64 cents. Is that a good investment? No. Stocks do not always go up. They will not always cut back. And the reason why is because they're based on companies. This company's CEO was one of the biggest fraudulent bankruptcy scam things on the planet. He has a bajillion ships sitting in a shipyard right here that he has to get rid of to liquidate, to pay off debts. Can't get rid of them. Bam, 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 bam. Have more scrutiny, have more denial, have more accounting fraud. And over the course of literally 2 decades, this stock turns from $160 billion and you'll have 63 cents. How does that happen? The way it happens is the company goes to shit. Alright, there's no other way to say it. And now with that said, the stock is absolutely phenomenal. They trade the stock all the time. Well, at least when it's got a pre-market gain, because it's got so much volatility, you can kind of see, if I can show, I mean, this is pretty, there's some pretty great chances that, it could turn, it goes from $40 to $50 a day. It's a little more, kind of around here, it goes from 6 to 10, goes from, 6 to 9. It's a fun stock to trade, I'm not gonna lie. I love it. But you don't want to hold that for 5 years. You don't want to buy it here and then never sell it because it will become almost worthless, right? And I'm sure they're going to do the reverse split soon enough, right? And so it's really critical that you sort of understand going in your investments, what bucket is this going to be? Is it going to be an active trade? Is it going to be a medium-term trade, swing trade? Or is this going to be a long-term investment? And then once you know where it is, figure out do I need to put a lot of attention on this and get out of the position in the next 45 minutes? Do I need to put a medium amount of attention on this and look at it for 5 minutes for the next month? Or do I need to look and just not even care about this at all? I don't do anything, right? And that's sort of the question that you want to take in because the decision that you make here will literally determine your returns everywhere else. If you're going to put no attention on it, you're going to get minimal returns. If you're going to put tons of attention on it, you're going to get maximum returns. And if you're in the middle, you can honestly, Like, you can make so much swing trading once you get into options. It's literally crazy. But yeah, that's the big takeaway here. That's the big message. That's the big story. That's the big shift. Is with Activision, obviously, didn't work out very well because you're not going to have a 100% hit rate. Nobody I know has a 100% hit rate. If they do, they're gods. I mean, they're amazing. But you're not going to win on like every single thing that you do, every investment you make. It's just not possible. So I guess with Activision here, you can kind of see like, you know, it looked good and it worked, but the stock just freaking tanked. And so, you know, if the stock just tanks, then, you know, what are you going to do? You're going to probably get stopped out and give a stop loss. And so just kind of one of those examples where sometimes it works out, or sometimes like it doesn't work out. And you know, Fortnite takes over, right? And so when that happens, it's just important to have downside protection and understand what your risks are when you get into that investment, when you get into that position. For me, like this is not that huge of a risk. You know, you risk 2 or 3 or 5% on stop loss, you know, you have 10, 15, 20% on the upside. Like that's pretty solid. But in the long term, like if you're thinking about a long-term investment, so many people, they don't even use stop losses, and like that's a big mistake, because if this thing keeps going down, and if it doesn't stop going down, like you don't want to like bag hold that, and so it's really massively, hugely critical. I know a lot of people that this board's got a lot of stuff on it. I know that they kind of got in like right at the peak emotional top of like cryptocurrency markets, and then they poop and they boop and they boop and they boop and they boop and it goes down and down, 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 down. And what most people don't have, they radically need, and that is like the core of investing, is some kind of freaking stop loss right here, so you don't have to hold it all the way down to $3 grand or whatever, right? And so it's really, really important that you sort of have that with every investment you make, whether it's an active investment or swing trade. You always have stop loss. With long-term investments, it's a little bit more difficult to have profit targets, but you also, if possible, usually like you're just expecting them to go up in the long term. If you are trying to go up and you're literally going to hold it for the next 80 years, then by all means, you know, totally ignore me and don't set a stop loss. But like you can literally double your percent gain if you just take a little bit of active management techniques and weave it into your long-term investments. And that's what I've been doing, and it just works really, really well. So with that said, thank you so much. We got a ton of value out of this module. Go out there, apply it, absolutely crush it, and I will see you in the next module. Thanks. Bye.